Today, we're going to be talking about a recent deal we did for a client of ours who was buying eightplex out in Alberta. So we got this deal from a broker in our brokerage, and the client was looking to see which program was available for them for the situation. Um, Basically, the client lives in BC. Two brothers that live in BC. They don't want to buy in BC because the price is so expensive, I would say. So they feel that with that down payment they have, this is probably a better purchase, which I think is a great move by them. So they rent in Vancouver, but they're buying in Alberta. Anything you want to add from just
Yeah, I
the
think
deal?
the reason they went to Alberta is because the cap rates are so low in
Mhm.
BC in general, especially Vancouver. So they were looking to get further something more of their money. So a lot of people, actually investors, are looking to Alberta now and
Yeah.
Saskatchewan and on the other coast too, like Newfoundland and Nova Scotia, to
Mhm.
get higher leverage. So because the cap rates are a lot higher in those areas, and obviously this one actually worked out really well, where we were able to get fairly high leverage compared to something you would get in Vancouver. It's probably like 35 to 50% at most. If you do
Yeah.
something in Vancouver, 50% is even generous, I would say, right? So
And just for those that aren't sure, like cap rate is like a return on investment, right? So when you hear the word cap rate, you compare it to like other investments. So if in Vancouver right now, I think cap rate's like say 2%. It's really low. So you compare that investment to a GIC where it's 4%. As an investor, what would you want to put your money in? Of course, there's appreciation in the asset too. So then in the world of cap rate, you as an investor are looking at, okay, do I invest in Vancouver or Alberta where I'm getting 5 to 6%? Or do I put my money into mutual funds or Bitcoin or gold, right? So there's so many different investment tools out there. And for them, this is one of they wanted something that has a little more, they wanted to invest in real estate because I think they invest in investments as well. So now they're
they have
just
a lot of investments already, so they want
lot.
to diversify.
Yeah,
This is their first real estate purchase.
yeah,
They're
yeah,
actually renting in Vancouver as well.
yeah.
So
Smart move, by the way, for they're
very smart
fairly
move.
young,
Yeah.
fairly young.
Yeah, they're young, but they're very savvy. So,
Yeah,
obviously a great move to purchase a eightplex, a good cash flow
brand new,
positive asset.
brand new too, by the way.
Brand new, just finished
Yeah,
last year in
yeah,
July. So
yeah,
yeah, it's a good looking product,
yeah.
and it's positive cash flow every month. Obviously they came to us. They're like, hey, we want to get as high as leverage as possible. Their banks, obviously, it's because it's conventional financing.
Mhm.
They only go up to 7%, right? Which they're looking
Yeah,
for like 85, 90 because they heard about the MLI Select program, right?
yes.
So
Very
obviously,
popular. Yeah.
we were able to kind of look around. Some of the challenges with these type of products is typically the seller wants a quick close, usually under 2 months. Now the issue with that is CMHC's processing time, anyway, with 8 to 12 weeks you put there. We've seen longer before as well. But right now, we'll say 8 to 12 just to be safe. So it doesn't quite add up to when usually the seller wants to
Yeah, it
close.
doesn't
So
line up
hence,
with closing date. Yeah.
yeah, so hence we have to find them a short-term bridge loan. And actually, we were able to find a bridge loan with the same lender that does the CMHC application. So it was actually a win-win for everyone. We can actually do the CMHC application and the bridge loan at the same time.
Just with the demand right now, the last couple of years for the program has created a bottleneck for CMHC to review deals. Like at one point, it was 6 months. Wait, 6 month
Yeah,
wait.
yeah. During COVID, it was like around that. Remember that?
It
Yeah.
was 6 to 8 months. It's gone down now. So we usually tell clients it's 3 to 4 months. So now there's a gap. Like by the time you put an offer in and you close, the seller wants a shorter closing, of course. And then the problem is that when we do this CMAC, it's a 4 to 5 month wait. So there's gonna be a gap of 2 to 3 months. So you need a loan to help bridge that gap so that you can acquire this property. It's very hard to find. I've rarely seen a deal where you can structure it so that the seller delays the closing to match the time frame of the CMAC loan. So yeah, definitely challenge number one. And the other thing I want to say is like MLI Select is only one of the many programs. We see a lot of brokers talk on many forums like MLI Select, but that's one of the programs only. There's different types, and that's why you want to, as an investor, you want to be able to speak to a broker to know navigate this landscape. Is MLI actually the right program for them? This situation, it made sense. In other situation, it doesn't, right? So, and sometimes the building is so old that it doesn't qualify or hit the proper points system for MLI. So I think those are all important factors. But long story short here is that the outcome, you can take a look here, is that the lender was offering 70% financing while we were able to get 90%. The amortization was 45 years versus 25 years. We could have went up to 50, but then it impacts how many units has to be affordable.
Affordable rent. Yeah, affordable rent. So this particular one, I think around
We balanced it.
60% or something. I can't
Yeah,
remember.
like
Yeah, around
almost half. I'll say
60%.
like 4 of
Yeah,
the 8 units
yeah,
roughly is
yeah,
affordable. Yeah.
yeah.
So it's a good balance. You got 45-year amortization, but not all your units have to be below market rent. The rate savings they got 4.25 or 6%. Bond yields are fluctuating, so by the time it finishes recording and stuff, this rate
It
could
might
be
even be
higher.
lower or it could be higher.
Could be, yeah. With what's
Yeah,
going on with the war right now and
yeah,
oil prices, that's going to change a lot. So key here is that they put very little down. Now they can preserve the capital and actually go invest in another building probably if they wanted to. That's the difference. From going from a 90% financing to 70%, that 20% can actually allow them to maybe pick up another cheaper building, like another 4-unit triplex, duplex, what I'm thinking, right? So
yeah. Well, it can really grow your portfolio once we get that type of leverage, right?
yeah,
So, you know, it can
yeah,
preserve your capital at the same time. You get positive cash flow from the building.
yes.
And that helps with, you know, buying your next purchase as well because you
Yeah.
have a lower rate and a
Well,
lower amortization.
another thing
Yeah.
to note is this is like a fix, like if you're applying the Burr model where you're buying, you want to rehab first before you actually refinance. I would not recommend this at all, right? We
Yeah.
have to go through a different strategy, right? So
Like
again,
we have bridge first, right?
yeah,
Because this way you can't break the mortgage. That's why CMHC is not always for everyone.
no,
Conventional is not always the answer. If this is a property in transition, then sometimes a private lender is actually
yeah,
the
or like
right
a B
answer.
lender,
Or
or
a
you
B
go like,
lender, yeah.
and you take like a variable term where the penalty's a
Variable
lot
term, where
smaller.
you can actually break the mortgage without too heavy of a penalty. Yeah,
Yeah,
for sure.
yeah. So it really depends on the situation. I don't want because the reason I want to emphasize is I think a lot of people just call me or call us and they say
MLI Select everything.
we want
Yeah,
MLI. Like
yeah,
they tell me that that's their solution, right? But it should be the other way around. Like
yeah,
if you were going to your family doctor, you don't tell the doctor prescribe me this drug. You don't even know what you need. You need to tell me your symptoms before I can tell you what prescription to give you. So when clients and brokers come to me like I want MLI Select, it gave me a solution where we have to actually reverse engineer and figure out is this the right deal? Is this the right product for you? I think that's the key thing I want to emphasize because I think the last 2 years we have too many calls on a weekly basis about I want that program. I want 95%. Don't we all, right? So I think the key
yeah,
thing here is that we have to work and look at the numbers because every building will yield a different financial DNA and a different result, right? So key things there. I'm not saying this is not a good program. It's great. It's just it has to fit what you're looking for, I think.